Before we get into this, I need to drop the big disclaimers. I'm not an attorney. I'm not a certified financial advisor. I'm not a tax expert. In fact, if there's some legally required certification or license to give advice, I ain't got it.
It's the world and I'm just the squirrel.
Fair warning, I'm going to drop a wide variety of information, and it's going to be a wild ride with some bigger concepts, but I promise I only use easy math, and I tie it all up neatly in the end. It's totally worth investing a few minutes to watch.
Yes, what do you hope for the future, young Skywalker is?
It's been almost 50 years since this stupid farm boy was handed an elegant weapon from a more civilized age, and immediately pointed it at his face. Actually, that part of the scene didn't really happen. Feel free to prove me wrong. I am your father. But regardless, 50 years is a very long time.
I cannot help it. She is the woman of my dreams.
Yes, why don't you look at it this way? In 50 years, she'll be just another toothless old hag.
50 years with her will be a lifetime with anyone else.
Hell, I'm 50 now. Let me tell you, the ride? No joke. So is this 50-year mortgage thing really a terrible idea? Or does it have some benefits that haven't really been discussed much? Let's hit the key points early. President Trump has proposed a 50-year mortgage, and Federal Housing Finance Agency Director Bill Pulte, the nation's top mortgage regulator, confirmed the plans. All things being equal, the math over the long term really hurts. Apparently, Dave Ramsey has been hospitalized. And if 50 is good, why not 100? Or more? While this may soften the market a touch, it doesn't actually solve the affordability problem. Home prices won't change much just because a few more buyers will have a little more reach. Supply and demand are still in full effect, and this just bumps up the demand slightly. And there are still a lot of details we don't have the first clue about. It's all theory so far, but let's explore it anyway. Let's hit the pros here. Longer term means lower payments, which makes homes slightly more affordable, which means more first-time homebuyers can get their foot in the figurative and literal door. And I got a secret bonus I'll get to shortly. Now let's discuss the cons. It's probably going to have a higher interest rate, or at least a higher effective interest rate. The amount of interest paid over that time is much higher. The banks win big if you hold it for all 50 years. And it's a half century of ongoing debt. I wouldn't be surprised if they make your unborn children co-sign the loan. Let's be brutally honest. Statistically, you're more likely to need a cemetery plot before you pay this thing off.
Well, should we give him a proper burial?
Yeah, why not?
Interestingly enough, the word mortgage comes from Old French and literally means death pledge. Sounds fitting to me. The 50-year mortgage has a lot of interest front-loaded. Yap all you want to about how it's not really front-loaded. It is. We're not going to do the boring math and fuck with the amortization tables. Just understand that any mortgage does it this way, and there is a huge difference in the amount of interest between a 30-year and a 50-year loan. Let's take a quick minute for some relevant concepts, history, and tools for the toolbox. Adjustable rate mortgages, also known as ARMs, start off with a lower interest rate than other loan types. There are some upfront costs to get started, but we're skipping all that crap. In this example, we see a $500,000 house with 10% down, and you can get into that for just a 4.75% rate. For your first 5 years, your mortgage payment is just $2,350. Man, that sounds like a really good deal. After 5 years, though, this rate can change drastically, and in this example, it's every 6 months that rate can change. This is called an ARM adjustment, and it will always be higher than your initial rate. The problem comes in when you can't sell or refinance before the ARM adjusts. Then you're paying a much higher amount every month. We saw this happen in the so-called global financial crisis in 2008, leading to tons of foreclosures. If there's one point that I think gets overlooked from that event, it's the time frame of the recovery. If you had bought a home at the very top of the market the day before it all came tumbling down, It took just 6 years to recover all of the value, from the first quarter of 2007 until the first quarter of 2013. Which means if you could hold on for at least 6 years, you'd break even. And in 7, you'd make a small profit. Mileage varied depending on location, but point stands. Every stock or other investing portfolio has one disclaimer plastered all over it. Past performance is no guarantee of future results. But bear this idea in mind. I'm going to come back to it in a couple minutes. Let's take a page out of my favorite playbook, the Ferengi Rules of Acquisition. When you sell your home for more than you paid for it, the profit you make is called capital gains. Section 121 of the IRS code says that if you sell your primary residential home and you actually lived there for at least 2 years out of the previous 5 years, you can legally exclude reporting those taxes on up to $250,000 for a single person or up to $500,000 for a married couple filing jointly. If you meet those criteria, then the exact words the IRS uses are, you don't need to report your home sale on your tax return. It's time for the secret bonus. Let's discuss arbitrage. Don't go to sleep on me yet. That's defined as the practice of taking advantage of a difference between prices in 2 or more markets. In this case, you're paying a little less every month for the same property. Here's a quick look at an easy math example. Joe and Jack buy identical neighboring properties for $500,000 on the same day in 2026. They have the same interest rate, but Joe has a 30-year mortgage and Jack went with a 50-year. Jack's monthly payment is roughly $250 less. That helps, right? Most people won't move again for about 5 years. So let's say they both sell on the same day in 2031 and the properties are still the same and are both priced at $550,000. Over those 5 years though, Jack has paid $15,000 less. Not counting the other mathy factors, Joe makes a $50,000 profit, but Jack makes $65,000. That's 30% more than Joe. And remember that capital gains tax exclusion? This is free money. Good on you, Jack. If everything about this checks out in the end, and it's just a longer version of a 30-year mortgage, is this a viable solution for homebuyers? Look, I'll be the first to say it's another tool in the toolbox, and to be sure, that's a good thing. So I'm going with both yes and maybe. We've already established that you're paying a little bit less per month. Not quite the ARM rates, but better than a 30-year mortgage payment, right? If the market crashes, see also the 2008 global financial crisis, or it stagnates for 10 years, you're still paying less over that period. So that stretches out your risk runway. In other words, this has some of the advantages of an ARM, but without the disadvantages of the time pressure. I think what we'll see is a 50-year shows the traditional spread on a 30-year becoming even more stratified. If you are well qualified, you can probably get a competitive or slightly lower interest rate. But if you are higher risk with a lower credit score or more debt or less income, I'm betting those rates will jump and the payments would be much closer to a 30-year loan that you wouldn't normally qualify for. But you'll probably be able to refinance later, so maybe that's got some legs to it too. If this pans out to be the same as or similar enough to a 30-year mortgage, and right now you need the extra financial buffer to be able to afford a home, then certainly consider it. If you think this is the only way you can get into a home purchase due to your credit or finances, send me a message. I will happily connect you with my great people who have outstanding resources to get you into a much better position. However, if you are otherwise in a decent spot and can use a 50-year mortgage to your advantage through arbitrage, it's definitely something worth considering. I will say that when it comes to using a 50-year mortgage to actually purchase a home, I think a lot of listing agents are going to dog on it for not having enough skin in the game. I hear that a lot. It's one of my most hated phrases in the real estate world. But the truth of the matter is, it's perception, and you're not going to be able to change that if you're slapping down a 50-year mortgage. It's something to consider because if you really need it, you're probably going to have to take a few shots at a few different properties in order to get a listing agent to nod their head and go, yeah, it's good enough. All of that being said, there are a lot of factors you need to pay attention to if you're even beginning to consider a 50-year mortgage as a possibility. Now, let's drive this point home correctly. Let's say that at the time Star Wars was released, Obi-Wan hooked Luke up with a house and a 50-year mortgage. Luke will still be paying on that mortgage until June 1st, 2027, another 18 months from the time I recorded this video. Luke was 19 years old in the original Star Wars. I refuse to call it A New Hope. He will be 69 years old on the payoff date. Buying a home is a commitment, sure, but the loan shouldn't take most of your life either.